All right, Caleb, we're going to be drawing a contrast between a seek and destroy market profile and a high resistance liquidity market profile. They have similar characteristics, but the main contrast is that a seek and destroy profile just basically stays inside of the middle of the range that's defined. So if we look at the September 23rd, 2024, you can find it in the 2024 mentorship playlist on YouTube. It's the title, How to Avoid Seek and Destroy Market Profile, something to that effect. But it's the recording that was recorded on September 23rd, 2024. This is a 5-minute chart, and I'm not going to show you the 1 minute and 15-second charts because of that video. You can go back and look at it and watch me actually call it out live, how it was problematic. And the main takeaway is this. At 7 o'clock in the morning, what will happen is the market will create a short-term low, short-term high. The high will be taken out. Each individual high gets taken out. Every individual low gets taken out. And it keeps coming back to the middle. Now, you're not going to know what the middle is early on, but as soon as you start seeing the price just cannot find its way out of just taking the highs and lows and coming right back to the middle, that's usually indicative of a seek and destroy. And just watch that recording again on September 23rd, 2024, because that's me literally explaining it as it's happening, how to identify it. Market trades above the short-term high here, comes down, creates a low, higher high here multiple times, relative equal lows, they take them, and ultimately take out the low of the day and come right back in to close at the middle of the range. So all of this range here, if you look at the highest high to the lowest low and put a Fibonacci 50% level, and you'll see we basically close right in the middle of the range. Seek and destroy will absolutely burn your account if you think that you're going to be able to capture something inside this day. Chances are you're going to fall victim to it. I certainly did fall victim to this in the mid-90s when I was first starting out. I didn't know anything about this, so it was something I had to learn about by getting beat up by it. All right, so now let's contrast the seek and destroy market profile with a high resistance liquidity market profile. All right, so we have the charts here on a 5-minute basis. Relative equal lows here, I mentioned that on Friday's September 27th, 2024's live stream. And the buy side, we swept that. And the difference between a seek and destroy profile and a high resistance liquidity profile is that seek and destroy reverts back to the middle of the range. It doesn't really make any meaningful protraction that is extended throughout the day. It just keeps higher highs, lower lows, but right back to the middle. So it's not a trending day. It's not a consolidation day. It is a seek and destroy day. So it's literally just going after the liquidity, and it's pausing while allowing the market to either build sentiment, or it's meant to break up or disrupt the present market sentiment that's in play at the time when that day is underway. So if you look at the difference between this day here, we had liquidity taken, and yes, the market went down and took the relative equal lows here where this unfinished business was left in play. So when they create these two lows that are relatively equal, the second one to the right of this one here, that's slightly higher, so that validates this as a high probability relative equal low. That means that this is going to be a prime candidate for the market to want to reprice back down there. We ran the highs here, so that drop down took us down into that very sell side liquidity pool right there. So while the market does a lot of give and take back and forth, looking really violent, even though it goes lower, it's that very nature that I dub this as a high resistance liquidity profile. So it does run to liquidity, but it doesn't do it in any inefficient manner. It does it very efficiently, meaning high resistance. It's going to get there, but it's not going to go there in a straight shot. All right, let's zoom in on that little area here on Friday. All right, so again, we're looking at the 5-minute chart, and the market rallies up ahead of the 9:30 opening bell, which is here. And we have a gap at the 9:30 candlestick. That is not your gap. That's not your fair value gap to work with. So you have to use a later fair value gap. So it has to be 9/31 or later than that. But between 9/31 or 9/31 rather to 10 a.m. Eastern time, you're looking for that 1 minute fair value gap to frame your trade on. Market trades up, creates a Judas swing, breaks lower, and look how back and forth every individual candlestick overlaps the previous range. So all of this back and forth price action, it's like a trading range market, moves a little bit lower, creates a new trading range, moves a little bit lower, creates a new trading range, moves a little bit lower, creates a new trading range, comes back up, creates relative equal highs, drops down, fails to take the low, comes back up, wipes the buy side above these relative equal highs, and then sells off right there. Now this part of this move right here, this is a low resistance liquidity run. That right there is a real quick sudden run. And see the inefficiency that's left here? That's a stark contrast between all of this back and forth. Very efficient delivery. This delivery here is a low resistance liquidity run. So what makes it low resistance? It creates these large buy side imbalance, sell side inefficiencies, and sell side imbalance, buy side inefficiencies, these singular candles. Okay, whenever you have these like that, that is a hallmark of a low resistance liquidity run. You don't see that in here. It's a lot of back and forth overlapping. Anything that would be a gap, they keep repricing back over top of it. That is redelivery. Okay, so you're going to get caught up in a lot of retracements that may stop you out. You'll have to look for the pattern that I mentioned as a turtle soup, where they're running the buy stops when it's bearish or running the sell stops when it's bullish. But ultimately, it trades down to where we were outlining it on Friday. But let's take a look at a 1 minute chart. All right, here's a 1 minute chart at 9:30 fair value gap. It trades up into it. But right here, that's your fair value gap. That's the one you're going to utilize. Okay, so you can see on a 1 minute chart, it still doesn't really thin out any of the price action. It's still very efficiently back and forth. Each individual candlestick, it keeps overlapping the previous range. In any type of fair value gap, it quickly wants to reprice to and redeliver. We have a small one right in here. You can see it goes right up into it there, but it's more appropriately described as a turtle soup. And we'll look at some of them as we go through. But ultimately, you can see we have a nice little run here to take the relative equal highs. And then we have it drop down after taking the relative equal highs. It's going to go after the relative equal lows and the sell side liquidity pool here that was shown to you on a 5 minute chart, and a nice precipitous drop there. This was why your trade in your combine panned out really well. And if you would have kept your limit order in there, you probably would have overshot the profit objective. You're not supposed to go over 50% of whatever it is they're trying to tell you have to aim for. And you had part of this run here as well. So you had two trades inside of a high resistance liquidity profile. Both of your trades, the long and the short, were both low resistance liquidity runs. All right, you see a 15-second chart here, opening range gap shaded here in this, I don't know what color that is. And then we have the first presented fair value gap. That's your fair value gap, Caleb. That's the one you're looking for. It has to form after 9:30. So 9:31 is the earliest it can form, up to 10 o'clock in the morning. So it was seen on the 1 minute chart before we dropped down to the 15-second chart. The buy side liquidity here, it rallies up. This is the Judas swing. I mentioned in the live stream that this is actually good, leaving the upper portion. Didn't completely close it into the opening range gap high. So dropping down, that return back into your fair value gap, that's your trade. That's your entry. That's how you would take your setup. But your stop loss, as I mentioned in the live stream, would have been twice this fair value gap's height. So your stop would have to be up a little bit higher than normal. But that's how you would trade a high resistance liquidity run, holding that type of trade and not chasing it down through any of this, because you're likely to get stopped out. I have this high here framed with the fib and down to a low that's prior to running out that relative equal low. And the Fibonacci level 50% here is a result of that. So what this is saying is at this price level and higher, that's a premium market. So a high resistance liquidity run profile, when you can frame the premium to discount, If it's a bearish unfinished business that you're aiming for, like a sell-side liquidity pool, as it was in the 27th of September, you're looking for the market to decline. So because it's high resistance liquidity profile, it's going to not have inefficiencies. It's going to be running for buy stops. So they run the market higher to take the buy stops and then sells off. They run the buy stops and then sell off. They run the buy stops, sell off. Run the buy stops, sell off. Run the buy stops, sell off. So anytime that the market has created a turtle soup above this red line, you're in a premium market relative to this high here. Now, why this high here? Because after we created this price leg at the high, down to this low, and we retrace back in, it's creating a consolidation that still is aiming for a much lower target. So we're looking at this area here as a deep premium that could be used to pyramid. You can add another position entry from here, but that would be the only one that I would think that was appropriate. Chasing all of it down here, if you start building in a larger position on a high resistance liquidity profile, chances are as you add more to your pyramided position, which you'll do later on when you get better at it, your core average price will drop lower, meaning that you're more prone to get to a net loss position if you start building up a lot. So if you add anything on a day like this, it's just do a single. Like unlike where that'll do 6 contracts in something like this, and then I can add 4 more here. On a day like this, it wouldn't be like that. It would be 6 and then add 1, because it's not going to move my core entry or average price entry significantly lower, which would mean that it would be easier for the market to get back up and take me to a net loss in any retracements. Consolidation here looks like a bull flag. Retail traders see that, and they like that. I mentioned that in the live stream. That's a turtle soup, and then it sells off. The main difference between high resistance liquidity profiles and the seek and destroy. Seek and destroy is basically untradeable. Okay, you're not going to want to trade them. And the high resistance liquidity profiles are tradable, but you have to keep your stop loss really, really close to your entry and only do one small pyramid, if at all, and then just submit yourself to time.